Most traders think the smart play is buying at the bottom and selling at the top. But Jesse Livermore, who turned a $5 stake into over $100 million, did the exact opposite. He bought stocks as they went higher. He added to positions only after they proved him right. Today you'll learn the 5-step tactical system he used to build massive winning positions. The same methodology that separated him from the 90% who lose by fighting the market instead of following it. Before we begin, drop a one-word comment describing your biggest challenge with position sizing right now. In the early 1900s, Wall Street was a battlefield. The ticker tape was the only intelligence feed. There were no computers, no real-time charts, no instant order execution. Yet Jesse Livermore consistently built positions that captured the majority of major market moves, while others either entered too early and got stopped out, or too late and missed the profit. His secret wasn't predicting tops and bottoms. It was something far more disciplined. It was knowing how to build a position like a general deploys troops. Here's where most traders go catastrophically wrong. They see a stock they like at $50. They think it's cheap, so they buy their full position, all 5,000 shares at once. The stock drops to 48. Now they're underwater. But they still believe in it, so they buy more, averaging down their cost. It seems logical. You're getting a better price, lowering your average entry. You think to yourself, if I liked it at 50, I should love it at 48. But this is backwards thinking. You're adding to a losing position. You're throwing good money after bad. You're doing exactly what a general would never do, reinforcing a battle you're already losing. Livermore learned this lesson the hardest way possible. Early in his career, he would average down, convinced his analysis was right and the market was wrong. He lost fortunes doing this. He stated it directly in reminiscences of a stock operator. Suppose a man buys his first 100 shares and that promptly shows him a loss. Why should he go to work and get more stock? He ought to see at once that he is in wrong, at least temporarily. The amateur buys on weakness, hoping for strength. The professional waits for strength before deploying more capital. Livermore discovered something profound. The market itself tells you when you're right. Not your analysis, not your research. The price action. If you buy a stock and it immediately goes against you, the market is sending a clear signal. Wrong timing, wrong price, or wrong stock. But if you buy and the stock rises, the market is confirming your judgment. This led him to develop what I call the tactical position building system. It's a 5-part military campaign for entering and scaling positions. Think of it like warfare. You don't commit your entire army to a battle before you know the terrain. You send scouts first. You probe enemy defenses. You test their strength. Only when you've confirmed weakness do you deploy your full force. Livermore wasn't interested in buying cheap. He was interested in buying right. He developed a strict protocol that required the market to prove him correct before he risked more capital. This system transforms position building from gambling into warfare, from hope into strategy, from amateur speculation into professional campaign execution. Principle number 1, begin every campaign with a reconnaissance position. Never deploy your full line on the initial entry. This was Livermore's most sacred rule for position building. Before committing significant capital, you must test the battlefield. Livermore would start with a small position, typically 1/3 to 1/4 of his intended final size. Think of it like a military probe. A general doesn't send his entire army into unknown territory. He sends a scouting party first to assess enemy strength, terrain conditions, and defensive positions. Your initial stock purchase is that scouting party. It's reconnaissance, not the full assault. This position exists for one purpose, to let the market tell you whether your timing and direction are correct. The size must be small enough that if you're wrong, the loss is manageable, but large enough that if you're right, you have something to build upon. Here's the deadly mistake amateurs make repeatedly. They see an opportunity and immediately deploy their full capital. Say they have $50,000 allocated for a trade. They buy 5,000 shares at $10 each, using their entire allocation on day one. The stock drops to $9.50. Now they're down $2,500, 5% of their capital, and they have no ammunition left to work with. It seems efficient. Why scale in slowly when you could maximize your position size immediately? You think to yourself, if I'm confident enough to buy 1,000 shares, why wouldn't I buy 5,000? But this reveals a fundamental misunderstanding. You're not confident, you're hopeful. Confidence comes from confirmation. The amateur wants maximum position size immediately. The professional wants maximum position size only after battlefield conditions confirm his strategy. The professional operates with surgical precision. Let's say Livermore wanted to build a 20,000 share position in a stock trading at $110. He would begin with 2,000 shares only. Not 5,000, not 10,000, 2,000. This is his probe, his reconnaissance mission. He buys those 2,000 shares and then does something most traders cannot do. He waits. He watches. He studies how the market responds to his order, how the stock behaves after his entry, whether buying pressure continues or evaporates. Think of it this way. You're testing enemy defenses before committing your main force. If the stock rallies after your entry, enemy resistance is weak. The path is clear. If the stock drops, enemy resistance is strong. Retreat and reassess. The professional understands that the first position is not about making money. It's about gaining intelligence. He's not interested in buying his full line cheap. He's interested in buying his full line correctly, at prices that confirm his judgment. Let me show you this principle in Livermore's own words and actions. In Reminiscences, he describes his scaling methodology precisely. He would buy 2,000 shares at $110. This is the probe. If the stock rose to $111, showing him a profit, he knew he was at least temporarily right in his operation. The market was confirming his judgment, but here's what separated him from everyone else. Most traders would see that 1-point profit and think, great, I'm up $2,000. Let me take the profit before it disappears. That's the amateur's instinct. Livermore did the opposite. Because he was right, because the market confirmed his direction, he went back in and bought another 2,000 shares. He was adding to a winner, not a loser. He understood something profound about market behavior. Stocks in motion tend to stay in motion. A stock showing strength will likely continue showing strength. By waiting for that initial confirmation, by requiring the market to prove him right before adding capital, he dramatically improved his win rate and position quality. This wasn't guesswork. This wasn't hope. This was systematic, military-grade position building. Principle number 2. Add to your position only when the market proves you right. Never, under any circumstances, add to a losing position. This is the cardinal rule of tactical position building. After your initial probe shows a profit, you've received battlefield intelligence. The enemy is retreating. Market resistance is weak. This is your signal to deploy additional troops. Livermore would add a second tranche, equal in size to the first, only after seeing upward price movement. If he bought 2,000 shares at 110 and the stock rose to 111, he would buy another 2,000 at 111. Not at 109, at 111? The higher price. This seems counterintuitive to amateurs. You're paying more per share than your first entry. You're reducing your average profit per share. But you're doing something far more important. You're building a position on confirmed strength, not on hope. You're following the market's lead, not fighting it. The amateur does exactly the opposite, and it destroys him. He buys at 110. The stock drops to 108. Now he's down 2 points per share, losing $4,000 on his initial 2,000 shares, but he still believes in his analysis. The company's fundamentals haven't changed. So he buys another 2,000 shares at 108, averaging down his cost to 109. It seems smart. You're lowering your break-even point. You think to yourself, now I only need the stock to hit 109 to break even instead of 110. I'm being strategic. But here's the brutal truth. You're doubling down on a position the market has already told you is wrong. You're adding to weakness, not strength. You're sending reinforcements to a losing battle. Livermore stated this explicitly. Why should he go to work and get more stock? He ought to see at once that he is in wrong, at least temporarily. The amateur averages down, hoping the market will validate his stubbornness. The professional adds up, letting the market validate his timing. The professional operates from a position of confirmation, not hope. Continuing our example, Livermore bought his first 2,000 shares at 110. The stock rose to 111, proving him right. He immediately bought another 2,000 shares at 111. Now he's long 4,000 shares with an average price of $110.50. The stock continues rising to 112. Again, confirmation. The market is telling him the path of least resistance is upward. So he adds a third tranche, another 2,000 shares at 112. Now he holds 6,000 shares at an average price of $111. The stock is trading at 112. He's sitting on a $6,000 unrealized profit, and every share is in the black. Think of it like advancing through enemy territory. Each successful advance proves the enemy is in retreat. Each confirmation gives you confidence to push harder. The professional builds his position as the market confirms his direction. He's not hoping for a reversal. He's following the momentum. This is the essence of trend-following warfare. You add troops where you're winning, not where you're losing. Livermore's own words demonstrate this philosophy perfectly. In the passage you're learning from, he stated, When I am bearish and I sell a stock, each sale must be at a lower level than the previous sale. When I am buying, the reverse is true. I must buy on a rising scale. I don't buy long stock on a scale down, I buy on a scale up. This is the clearest articulation of his methodology. Buying on a rising scale, each purchase at a higher price than the last. It violated every instinct that amateur traders have. They want to buy cheap. Livermore wanted to buy right. He gave a specific example in his memoir. He would buy 2,000 shares at 110. If it rose to 111, showing profit, he bought another 2,000 because he was right. If it continued to 112, he'd buy another 2,000. He was pyramiding on strength, building his position as the market confirmed his thesis. The result? By the time he finished building his position, he held 6,000 shares at an average price of $111, and the stock was trading higher. Every single share was profitable from the moment he achieved his full position. This is the power of confirmation-based scaling. You're never underwater on your full position. You're always building from strength. Principle number 3. After a pullback, test the market's ability to absorb your orders before deploying your main force. This is Livermore's intelligence gathering system for position expansion. Markets don't move in straight lines. Even strong uptrends experience reactions, pullbacks, moments where the advance pauses to consolidate. Livermore knew this. After building his initial position, he would wait for a reaction back to his last entry point. When the stock pulled back and then started rallying again, he would place a testing order, a probe to see if buying power remained strong. Think of it like sending a small unit forward to test enemy fortifications after a temporary retreat. You don't know if the enemy has merely regrouped or if they're exhausted and on the run. The testing order tells you which scenario is true. It's reconnaissance before the main assault. The amateur sees a pullback and panics or becomes overconfident at the wrong time. Let's say the stock rallied from 110 to 114 after his entries. Now it pulls back to 112. The amateur does one of two things, both wrong. First scenario, he panics. He thinks, the move is over. I should have sold at 114. He exits his position, taking a small profit, only to watch the stock resume its rally to 120 without him. He mistook a healthy consolidation for a reversal. Second scenario, he becomes overconfident. He thinks, great, a dip. Time to load up. He places a massive order for 10,000 shares without testing market depth. His order drives the price up to 113.50 cents, and then selling appears. He's overpaid and exhausted the buying momentum. The amateur either exits too early from fear or enters too large without verification. The professional tests first, then acts based on what the test reveals. The professional conducts systematic intelligence gathering. Continuing our example, Livermore held 6,000 shares at an average of $111. The stock rallied to 114, then pulled back to 112.50 cents. Now it's starting to rally again. At 113.75, Livermore places an order to buy 4,000 shares, but he's watching how this order gets filled. If he gets 2,000 shares at 114, 500 at 114.25, and the rest on the way up to 115.5 for the last 500, he knows something critical. Strong buying power exists. The market absorbed his 4,000 share order and drove the price higher in the process. This tells him the trend has momentum, that buyers are aggressive, that the path of least resistance remains upward. Think of it like testing a bridge before marching your army across. You send a small unit first. If the bridge holds and shows no weakness, you commit your main force. If the bridge creaks and sags, you find another route. The testing order is your bridge test. It tells you whether the market can handle your full position size. Livermore describes this exact technique in Reminiscences through the famous Deacon White story, though the principle applies to his own methodology. When building a large position, Livermore would place an order after a reaction and watch carefully how it got filled. He stated, well, if I get that 4,000 at 113.75, I know something's wrong, and I'll give a testing order. That is, I'll sell 1,000 shares to see how the market takes it. This is critical. If his order fills too easily at the price he wanted, it means no buying pressure exists. The market can't even absorb his 4,000 share order without dropping. That's a red flag. But if he gets his 4,000 shares at progressively higher prices, 2,000 at 114, 500 at 114.25, and the last 500 at 115.5, then he knows he's right. He stated explicitly, then I know I'm right. It is the way I get the 4,000 shares that tells me whether I am right. This is battlefield intelligence in action. He's not guessing whether demand exists. He's testing it. He's probing the market's depth and strength. Only after confirmation does he commit additional capital. The test tells him everything he needs to know about whether to continue building his position. Principle number 4. Resistance is a sign of strength. If you can buy large size too easily, the market is telling you demand is weak. This is Livermore's counterintuitive insight into order execution. Most traders think getting filled easily at their desired price is good news. Livermore understood it was often a warning sign. If you place a large order and it gets filled instantly at your limit price or better, it means no competition exists for those shares. No other buyers want them. You're the only one buying, which suggests you might be buying at exactly the wrong time. Think of it like storming a castle and finding the gates wide open, no guards present. Your first thought shouldn't be, excellent, easy entry. It should be, why is this so easy? Where are the defenders? Is this a trap? A strong market makes you work for your position. A weak market gives you all the shares you want with no fight. The amateur loves easy fills. He places an order to buy 5,000 shares at $50. It fills instantly, all 5,000 at $49.95. He's thrilled. He saved 25 cents per share, $2,500 total. He thinks he got a bargain, but what he actually got was a warning sign he didn't recognize. The market gave him all 5,000 shares below his limit price instantly. That means sellers were eager to dump stock and no other buyers wanted it. He's the sucker at the table. You think to yourself, great execution. I got filled below my limit. But you should be thinking, why was this so easy? Where is the demand? The amateur celebrates easy fills. The professional becomes suspicious of them. A stock that's truly strong makes you chase it. A stock that's weak lets you buy all you want. The professional wants to see resistance. He wants his orders to push the price higher. When Livermore placed his testing order for 4,000 shares, he wanted to see it filled at progressively higher prices. 2,000 at 114, 500 at 114 and 1/4, more at 114 and 1/2, and the final shares at 115 and 1/2. This execution pattern told him demand exceeded supply. Other buyers were competing for the same shares. His order drove the price up because aggressive buying existed. The market was strong enough to absorb his size and still move higher. This is confirmation of trend strength. Think of it like fighting for territory. If you advance and face fierce resistance, it means the enemy cares about that ground. It's valuable. But if you advance and face no resistance, either you're in the wrong place or you're walking into an ambush, the professional wants the market to fight back against his orders. It proves the territory is worth taking. Livermore stated this principle explicitly. I never want to buy stocks too cheap or too easily. This sounds insane to amateur traders. They want cheap and easy. But Livermore understood market dynamics at a level few ever reach. He explained his reasoning clearly. If he placed an order for 4,000 shares and got them all at his limit price or better too easily, he would immediately sell 1,000 shares as a test. He wanted to see how the market absorbed selling pressure. If his 1,000 share sell order dropped the price significantly, he knew the market was weak. No strong hands were present to absorb supply. But if his testing order for 4,000 shares forced him to pay progressively higher prices, each tranche costing more than the last, he knew strength existed. He stated, "It is the way I get the 4,000 shares that tells me whether I'm right in buying that particular stock at that particular time." This is genius-level market reading. He's using order execution as intelligence gathering. The market's response to his orders tells him everything about underlying supply and demand dynamics. If he can buy easily, demand is weak. If he has to fight for shares, demand is strong. Only in the latter case does he want to build a large position. Principle number 5. Your full position should be the result of multiple confirmations, not a single decision. Build your army one battalion at a time, each addition justified by battlefield success. By the time Livermore reached his full position size, he had received multiple confirmations from the market. His first purchase showed a profit. His second purchase showed a profit. His testing order revealed strong demand. Each step proved him right before he took the next step. His final position wasn't built on hope or prediction. It was built on repeated validation from the market itself. Think of it like a military campaign with multiple objectives. You don't declare victory after taking the first outpost. You take the outpost, verify it's secure, then advance to the second objective, then the third. Each success confirms your strategy is working. Your full force is deployed only after you've secured multiple positions. Livermore's full position was the culmination of a systematic campaign, not a single bet. The amateur makes one decision and lives or dies by it. He analyzes a stock, decides it's going up, and buys his full position immediately. 5,000 shares at $50 all at once. Then he waits and hopes. If the stock goes up, he feels like a genius. If it goes down, he feels like an idiot. His entire outcome depends on that single entry decision. But here's the problem. He has no feedback mechanism. No way to adjust. No way to test his thesis before committing everything. If he's wrong, he's fully wrong. If market conditions change after his entry, he has no flexibility. You think to yourself, I've done my analysis. I'm confident. Why would I scale in slowly? But confidence without confirmation is just arrogance. The amateur bets everything on his analysis. The professional bets progressively as the market confirms his analysis. The professional builds his position through a series of confirmed steps. Let's see Livermore's complete campaign. First purchase, 2,000 shares at $110. Stock rises to $111. Confirmed. Second purchase, 2,000 shares at $111. Stock rises to $112. Confirmed. Third purchase, 2,000 shares at $112. Stock rises to $114, then pulls back to $112.50. Holds above his entry points. Confirmed. Testing order, 4,000 shares. Gets filled at progressively higher prices from $114 to $115 and 1/2. Strong demand confirmed. Now he's long 10,000 shares with an average price of approximately $112, and the stock is trading at $115.50. Every single share is profitable. Think of it like building a fortress. You don't construct all 4 walls simultaneously. You build one wall, ensure it's solid, then build the next. Each wall is tested before you proceed. By the time you're finished, you have a structure you know is sound because you verified each component. Livermore's full position was a tested, confirmed, validated structure. Not a hopeful guess. Livermore's complete methodology is summarized in his own words. Let us suppose, for example, that I am buying some stock. I'll buy 2,000 shares at $110. If the stock goes up to $111 after I buy it, I am at least temporarily right in my operation, because it shows me a profit. Well, because I am right, I go in and buy another 2,000 shares. If the market is still rising, I buy a third lot of 2,000 shares. This is the complete system. Initial probe, confirmation, second entry, further confirmation, third entry. Then he waits for a reaction, tests market absorption with a larger order, and only after that test confirms strength does he deploy his full capital. By the time he's fully invested, he has received 4 or 5 separate confirmations from the market. The result? He stated, I never buy stocks too cheap or too easily. His full positions were always built on strength, always confirmed by price action, always validated by the market's ability to absorb his orders without collapsing. This is why his win rate was so high. He wasn't predicting. He was confirming. He wasn't hoping. He was following. He built positions the way a general wins wars, through systematic, confirmed, progressive advance into enemy territory. Let's bring this complete methodology together. Livermore's genius wasn't in any single technique. It was in the systematic integration of all 5 principles into one coherent campaign. The tactical position building system is military-grade methodology for entering and scaling positions. It begins with the initial probe, ensuring you test the battlefield before committing your main force. You never deploy your full capital on the first entry. You start small, 2,000 shares, when you want 10,000, giving yourself room to build if the market confirms your thesis. It moves to confirmation-based scaling, ensuring you only add to winning positions. Each subsequent purchase happens at a higher price than the previous one. You're buying strength, not weakness. You're following the market's lead, not fighting it. It demands testing orders, ensuring the market can absorb your size. After a pullback, you probe with a large order and watch how it gets filled. If filled too easily, you retreat. If filled at progressively higher prices, you advance. It incorporates the arithmetic of execution, ensuring resistance indicates strength. You want your orders to face competition. You want to see other buyers forcing you to pay up. Easy fills are warning signs. Difficult fills are confirmation. And finally, it requires multiple confirmations, ensuring your full position represents repeated battlefield victories. You're not building on one decision. You're building on 4 or 5 confirmed steps, each proving the previous one was correct. This is not a pattern. This is a mental discipline. This is the difference between gambling and warfare. Here's what this really means. The 90% who fail enter full positions immediately based on analysis and hope. They're driven by the fear of missing out, the desire to maximize profit on every point of movement. They see a stock at $50 and think, I need to get my full position now before it runs away from me. So they buy 5,000 shares at once and hope they're right. The 10% who succeed build positions systematically based on market confirmation. They have cultivated patience and discipline. They see the same stock at $50 and think, I'll buy 1,000 shares as a probe. If the market proves me right, I'll add more. If it proves me wrong, I'll exit with a small loss. They see the same setup and have a completely different reaction. This system transforms position building from speculation into systematic warfare. It is a methodology that eliminates the largest source of trading losses, being fully wrong with full size. When you scale into positions, you're never fully committed until after you're fully confirmed. Your biggest positions become your highest probability trades because the market has already validated them multiple times. Now, let me be clear, this is not easy. Livermore himself said, "It took me years to realize the importance of this. It also cost me some hundreds of thousands of dollars. This system will not eliminate losses. You will still have losing trades. What it will do is ensure your losses are small, probe-sized losses, while your winners grow into large, confirmed positions. But only if you have the discipline to wait for confirmation before adding size. Most won't. They'll see that first small position show a profit and say, I knew I was right. I should have bought more initially. They'll see a stock run 5 points without them because they're waiting to add, and they'll abandon the system. They'll go back to buying full size immediately, hoping to catch the entire move. The amateur wants maximum position size immediately. The professional wants maximum position size only after maximum confirmation. Will you have the discipline to build like a general, or will you gamble like an amateur? So here's my challenge to you. Take your next trade and apply the initial probe principle. Don't buy your full intended position. Buy 1/3 of it, then wait. Watch how the market responds. Does it move in your favor, confirming your timing? Or does it immediately move against you, telling you to wait? Don't just watch this video and do nothing. Livermore spent hundreds of thousands of dollars learning these lessons the hard way. You just got them in minutes. The question is, will you apply them, or will you keep buying full positions and hoping you're right? If this changed how you think about position sizing, hit that like button. Subscribe for more deep dives into legendary trading methodologies. And drop a comment. Which of these 5 principles was most eye-opening for you? Was it buying on a rising scale? The testing order concept? The idea that easy fills are warning signs? I read every comment, and your feedback shapes future content. Remember, this video is for educational purposes only. This is not investment advice. Jesse Livermore's strategies require study, practice, and discipline. His position-building methodology demands patience most traders don't have, and discipline most won't develop. Always do your own research, and never risk more than you can afford to lose. Position building amplifies both gains and losses. Understand the risks before implementing any strategy.